Your brain is worth 0 rupees or 10 crore. Why do some investors always win while others always lose? Investors don't fail because of bad markets. They fail because there is an issue with the brain. Predictable, invisible brain trap. Think, why do you keep switching funds? Why do you sell often? Why do you buy new funds? Then there is somebody who silently keeps getting richer. It is not IQ, it's your brain. You don't need a better mutual fund. What you need is to fix this inside of your head first. So we will see this concept called buyer's market and seller's market. Seller's market, let us understand this visually as a red market or a red zone. You will find high past returns, probability of low future returns. This is a zone where investors may consider selling some, if not all, to lock in the profit. This is a zone where you follow asset allocation investing framework. Buyer's market, visually see it as a green market. There is fear about something that is really bad that is going to happen. There is some uneasiness in the air, but there is also probability of higher attractive future returns. This is a zone where investors should consider investing very aggressively in equity funds because the probability of success here is higher than the probability of a loss, of course, over a longer time horizon. And then you have a neutral zone, yellow zone, where a specific action may be again required. So we will discuss that, but most investors don't follow this due to the opposite chemicals generated in the brain during these zones. In fact, they do the exact opposite. They invest most in the seller's market or red zone, and they do not invest in the buyer's market or during the green zone. But how do you spot or understand if you are in a buyer's market or are you in a seller's market so that you can act correctly? So we will see that in a minute in this video. Let me take a short detour. You have heard of the concept called Fibonacci sequence, a pattern found in seashells, flowers, even human body. For example, 5 is the sum of the previous two numbers. Similarly, 13 is the sum of 5 and 18. This sequence beautifully illustrates the power of compounding. Starting small, growing exponentially over time. At first, the growth looks boring, pointless, it is too small. But somewhere after a few repetitions, it suddenly takes off. It compounds, it snowballs. That's exactly how wealth works. If you invest 25,000 per month for years, then one day 1 crore mark appears and your portfolio starts adding lakhs in shorter and shorter intervals. Not because you work hard, but because you waited long enough for maths to work to reward your patience. Once your portfolio crosses 3 crore, you gain 1 crore every 2 years. And when the portfolio crosses 6 crores, you gain 1 crore every year. Compounding is the Fibonacci of finance. And here's the thing, most people never get to this phase because their brain quits during the boring part, that is in the initial 3 to 5 years. Now, red market or seller's market does not mean you completely sell or you avoid investing. It does not mean you sell everything out completely and get out of the market. It means one has to be more cautious, more careful about what he is buying. Unlike in a buyer's market, we will discuss the responsible action needed for each of these markets in this video. In a buyer's market, it is easier to buy. There are many bargains and it is very easy to spot them. The probability of attractive future returns is higher here than in the seller's market. Let us take a look at the 2007 classic seller's market. Valuations were high. The index was in the red zone. Yet, the market continued to climb for a while. Even in an overheated zone, money could be made, but only you were lucky enough to exit early. However, what followed in 2008 was a sharp, brutal correction. Much of the paper profits evaporated. This teaches an important truth. In a seller's market, gains can be deceptive if not backed by disciplined exit plan. Now, here's the second insight. Markets don't stay fixed in one zone. They oscillate between seller's neutral and buyer's market. These transitions are not always clean or very obvious, meaning avoiding the markets entirely when it is expensive could mean you have to end up waiting for years. But going all out without a strategy could also wipe out years of gains that you have made. So let us understand how to identify if you are in a buyer's market or if you are in a seller's market or a neutral market. Use screener and look at the data. You can consider 4 or 5 metrics. The first metric is to check if the current PE is above historic average or below. A higher average of PE at this point means an expensive or a seller's market. As a corollary, if the PE current is lower than the historic average, it may point to a buyer's market. But data shows that most retail money is invested in seller's market or during red market. Very little investment is done during green or buyer's market. There are 3 chemicals that hijack investor behavior. In a seller's market, dopamine gets secreted in the brain. This is a reward-seeking chemical. This triggers FOMO in investors. So although logically one has to be cautious, these chemicals give us misplaced courage to invest at the wrong time because brain confuses temporary excitement with safety. Also, if P is lower than historical average, directionally we could be in a buyer's market. Here cortisol gets secreted in the brain. This is a fear response chemical that forces investors to sell in panic. Ironically, our brain fires the wrong chemical at the worst possible time. It fuels greed at the top and fear at the bottom. It's the ultimate irony. When we should pause, we rush in. When we should act, we freeze. And thanks to this brain chemistry, oxytocin is the third chemical. It is responsible for social bonding in humans. This triggers herd behavior, meaning we do what everyone else is doing. This pushes us to do more of what we should not be doing at both these times. These 3 chemicals don't care about logic. What they care about is survival. And in the markets, that's a dangerous trend. I was researching how our brain messes up with our investing decision. Dopamine hits, cortisol spikes. I came across this book, The Calm Prescription. It is not about investing, it's about health. But one idea hit me hard. Calm is not just for peace of mind. Calm is a strategy. In a world screaming for action, calm investors think clearly. They don't chase aggressively the red zones or seller's market, and they do not panic in green zones or buyer's market. They pause, they breathe. This book shares 75 tools for staying calm. I realized some of them could be the difference between compounding your wealth quietly and reacting emotionally. So if your money decisions feels for you like say an emotional roller coaster, it is time to train your nervous system too. So when valuations are low, when the media says the sky is falling, that is when the calmest investors, they build wealth, not because they are brave, but because they have trained their mind, their brain. Now, can we as humans conquer these brain chemicals and escape from the trap? Broadly, we can categorize our brain conflict into 2: cognitive biases and emotional biases. Cognitive biases, mind tricks, these are happening due to improper analysis of data. This can be corrected. Example is anchoring bias, recency bias, or confirmation bias. These can be overcome with awareness, knowledge, and training. It's like a bad software. You update it and you're fine. However, the second one is very difficult to conquer or correct. This is the emotional bias. It is hardwired into us. Fear of loss, overconfidence, herd behavior, these are rooted in biology, much harder to change. So this is not faulty logic. It is body reacting to fear like you're being chased by a lion. Obviously, you need to run in the real world, but in the investing world, this often backfires. So what should an investor do? In the green zone, that is buyer's market, the normal investor emotion is fear. The common mistake investors do is that they don't act, but the right strategy is to accumulate more equity. Similarly, in the red zone, that is seller's market, the normal investor's emotion that they exhibit is euphoria. There's a lot of courage, a lot of confidence, but the common mistake that they do is to invest a lot of money by lump sum. So the right strategy in the zone, the seller's market, is to reduce equity, rebalance and diversify. And then there is a middle path, that is the yellow zone or the neutral zone, which is neither buyer's market nor seller's market. And here investor emotion is normally confusion. You get attracted and led by news. And the common mistake investors do is to wait for clarity. But the right strategy is to stay consistent with your original plan. We just saw how to identify whether you are in a buyer's market or you are in a seller's market using the well-known PE ratio. PE is not the only metric. You can also use other valuation indicators like price to book or dividend yield or market cap to GDP ratio. For price to book and market cap to GDP ratio, look at where the current value stands in relation to the long-term historical average. If it is significantly above, it typically signifies a seller's market. If it is well below the average, it often points to a buyer's market where value may be emerging. But for dividend yield, higher is actually good from a valuation perspective, which means if the dividend yield is high compared to adjusted historical range, this usually means that stock prices are low compared to the dividends that are being paid. It is often a sign of reasonably valued markets, seen more in buyer's market condition. Now, low dividend yield compared to adjusted historical average, this usually means stock prices are higher relative to the dividends, signaling overvaluation. This is common in sellers' market phases. If today's yield is higher than the historical average, buyer's market. If today's yield is lower than the historical average, then it could be seller's market. In the new world of AI and ML, every investor will be smart. They'll all be using the same super intelligent output from ChatGPT or other AI-led platforms that are curated to bring investing portfolios. So all investors will have equally good analysis. Everyone is using the same tool now. The perfect portfolio does not matter if you do not take action. Most investors lose out not because of lack of intelligence, but because they act too late, too little, or too emotionally. AI is no longer the edge. The only edge left is behavioral. The investors of the past had less information but more courage. The investors of the future have more information but less clarity. Your brain is either overthinking liability or your biggest wealth building asset. If you enjoyed the content of this video, please hit the like button, subscribe to this channel, and share this with a friend